in the mortgage world, you were just talking about with rates starting to creep up, it does entice people to jump into a market and get this little bit of fear that they may not be able to afford what they want to if rates continue to climb. You brought some numbers about simply what a small change in interest rate can mean.
Well, I think, first of all, I've been doing this for, 14 or 15 years now. It's always interesting that the most activity we see in the mortgage business is not when interest rates are on the decline. It's when interest rates are on the increase.
Fear of loss.
Fear of loss, that people take a lot of action. So we're seeing a lot of people who, quite frankly, could have gotten a much lower interest rate 3 or 4 months ago on a refinance, for example, but they delayed and postponed because they thought interest rates would be around forever. And now they're seeing them going up. They're doing this mad rush, because there's still a benefit to refinance, even though the rates aren't as low as they were, say, November, December. So that's interesting.
Yeah.
And then on the purchase side, we're seeing the same thing, is that kind of that demand and that lack of inventory is making it challenging for buyers, but they're also realizing that if we don't, which is a good thing, I think buyers are realizing if we don't take action, these low interest rates are going to be gone. And I think buyers more and more need to understand how significant that really is. The interest rates in the 3s and 4s is not where the Fed wants them at all. Historically, rates have been in the 7 to 8% range for a 30-year fixed. So if we say, for example, a 30-year fixed today is around 4%, and the difference between where rates could be at 6% in a couple of years is almost $500 difference per month for a $400,000 loan. So it's pretty significant and pretty kind of astonishing to look at the numbers.
Yeah. So when people are out looking at houses, Jed and Rodolfo, does this start to creep into their mind when they see mortgage rates going up? They're in dialogue with their lender. And how do you guys help them realize, look, well, not only can we not find a house because there's no houses on the market, but rates are going up, so we have to act fast on something that isn't there. I mean, it's a lot to juggle.
Yeah, absolutely. I think most buyers are acutely aware of interest rates, even more so than the agents. They're checking all the time. They're speaking with their lenders, and they have to be aware of where things are and if they're moving up or down. So as the agent, certainly we encourage them to talk with their mortgage broker to understand the market and to be ready to pounce when the right opportunity is available.
And the right communication with the mortgage broker is very important, because sometimes they see the numbers fluctuating, but they have already locked. And sometimes we have clients on contract and they call panic. The interest rate went so high, but you have a lock.
Right.
And that part of communication, yes,
sure.
is true.
What questions do you guys see right now from some of your clients when it comes to mortgages?
Well, I think the perception over the last few years is that you need 20% down to buy a house. And there was a time when that was correct. It certainly is not correct now. And so that would be a question for Ryan as to good options that are available for lower down payment buyers.
Yeah, that is a great question. We actually get that a lot, in that misperception that you need 20% down. So, there's a lot of great loan programs out there at 3 and 3.5% down. If someone can put 5 to 10% down, that's going to put them in a much better financial position. But 3 to 3.5% down. There's even a couple programs out there that you can still do 0% down. But I don't promote it. I think it's really kind of few and far between. So really, as a buyer, I think they need to understand that you don't necessarily need 20% down, but on the other side, you will need something. Look at 3 to 5%, and that would put you in a really good position and have a lot of options available.
Right.
Sure.
One of the main questions for me is the only option out there is the 30-year fix. And people got stuck in that because the subprime market, what happened, and then they said, everything else got eliminated, and the only option is the 30-year fix. Yeah. And I know it's depend of everybody's financials, but the 30-year fix is not for everybody. Yeah. Right? There's different professionals who needs other type of loan programs. And how do you see that as an industry, a mortgage industry?
Yeah, and I think there's different times that different loan programs make more sense and not. So you can go on the fixed side. 30-year fix is great. That's pretty standard, what I'd say majority of people kind of gravitate towards. But they can also do 10 and 15-year fixed if they want to get a lower term. Okay, higher payments but a lower term. So basically just have a pace to pay it off faster. And on the other side, you can do an ARM where, again, that got a bad rap for a lot of times because people's arms are adjusting now. But again, the total misconception, which is amazing, that anybody, and I just met with a client yesterday, is when they bought their home in 2006, they had a 5-year ARM at 6.25%. Okay. They came in saying, oh, my God, my arm adjusted, everything else. Their interest rate is 2.875 today. Their payments have literally dropped in half. And now they're concerned about, well, when rates start going up, what's going to happen? I'm like, oh, my God, you were at 6. You went down to 3 because that's the nature of how ARMs work. And you're worried about it possibly going back up to 6. We have to get some perspective here. Okay, so I think it's, when it comes to ARMs, it's just understanding how long somebody's really going to be in a mortgage or in a home, because you can get lower interest rates on ARMs as opposed to fixed. But it's not for everybody, but it's also about education and making sure they understand kind of the mechanics of everything, and then they're comfortable, and then you can find the logic within the right strategy from there.
Jed Kleiman, Rodolfo Hernandez, Ryan Leopold, join me, guys. When you start talking about the different loan programs that are out there and the different houses that are out there, oftentimes there is the perception that a certain house should only be financed a certain way. And a lot of times people think they're actually getting a loan on a house when the reality is they're getting a loan to themselves. When you start competing over certain houses, then oftentimes I feel that people, as Jed and I talked about, you get emotional. You want to buy this house. And some of the financial strategies you had at the beginning change. Mm-hmm. My most I want to pay is $2,000 a month. But we love this house, so we're willing to go to $3,000. That's a real thing that's happening right now, where people are willing to blow their budget when they find the right house in this competitive market. How do you all deal with that in the conservativeness of the initial maybe meeting that they have with Ryan on a purchase, and then the reality of, well, I'm going to have to spend more?
I'll answer that quickly on the mortgage side, is that anytime we meet with somebody, there's always that threshold of, hey, this is how much you can qualify for or be approved for, and then you're talking about where you feel comfortable. Okay. And so within that range, we always want to kind of find an equal balance and not overextend anybody and put anybody in a bad position to deal with what we dealt with in the past. But at the same time, especially by doing the show every week and meeting great agents like you guys, I get a really good feel for what the market dictates. So when I'm with a client and they go, I don't want to spend more than $1,200 a month, but I want a $400,000 house with nothing down. And the perspective is you're not going to find that home out there. So change your perspective a little bit, work through some things, and you can change your budget around if it's really important to you. So I think on the lending side, a good lender is going to look at their overall financial position and help create a strategy. And sometimes it could come down to, let's cut out a latte a week, maybe, change the way you do taxes with your income every month, maybe a little bit less to 401k, whatever. But there's different ways to look at it. That,
or pay off, a lot of people, as opposed to a big down payment, we need to pay off a car.
Mm-hmm.
There's a lot of different ways to do that.
For sure.
Well, I would answer that by saying at the end of the day, we're here to help people be successful and get what they want. And, certainly we don't want anyone extending themselves beyond what they can afford, but, that's a personal decision to the customer.
Sure. Oh, we're still doing stated income loans all over the place. No, I'm just kidding. Yeah. As high as people want to go, $1 million, call it a day.
But here's the problem on the lending side is the consumer has to recognize that to just be prepared and come in with an open mind and talk through all options. Because if you change your strategy as you fall in love with a home who want to make an offer that day, when your mortgage strategy is not set up for that piece and you're really not approved. I had a client who just came in doing a VA loan above the limits, but they just made their own assumption that they are approved for more because they make plenty of money. When there's still rules that we have to go through that because they cap themselves at a certain amount, now they put themselves in a tough position where they didn't get the house.
Right.
Yeah.
So I have a friend in Las Vegas who does real estate, and he was telling me yesterday they're encountering this problem where the demand is so high that properties are selling like 10, 20% over listing price, but also over appraised value. And they're having this hard time getting those homes appraised, and now they need to bring cash after the loan to actually get the offer. So now when we're showing properties, say, okay, the loan is this max, plus you will need to bring $50,000, $60,000 cash at the end. Do you see that coming to Seattle? As a
Absolutely.
mortgage?
Absolutely. You know, I just met with a client yesterday who ran that exact example. She was coming to me asking for my help and see if we can get a second appraisal because she's looking to buy a house for $640, but her appraised at $600, thinking that I can come in and get a higher appraisal. And so I did the research. I go, well, you're buying a $600,000 house. I mean, it's not a $640,000 house. So yeah, the reality is coming, and I think over the next several months, you're going to see it more and more as demand keeps increasing and supply keeps staying low, for sure.